The case of Lehman Brothers is particularly odd in this regard. There are two things that are odd about it. It's very unclear as to why Paulson, Bernanke, and Geithner forced Lehman into bankruptcy. They made a particular set of statements about that. Those statements are probably not true, and they probably didn't believe them even at the time. There are many other possible reasons. I don't think that anybody really knows. So that's one kind of mystery. The more interesting mystery, though, is what we do know about their forcing Lehman into bankruptcy. And what we do know is that they didn't know what its effects would be, even when they should have. So very much to many people's surprise, Henry Paulson and Ben Bernanke did not know, and they have admitted this in public, they did not know that foreign bankruptcy laws were such that Lehman's Tokyo and London offices would be forced to close and the assets in those offices frozen, which paralyzed the London hedge funds, which meant that a lot of assets were withdrawn from the system, and a lot of people panicked because they couldn't get their assets back. And they also didn't know that Lehman Brothers paper was widely held in money market funds, and that would cause money market funds to break the buck, and that would cause, a run on the money market funds. Henry Paulson, having been CEO of Goldman Sachs, one might have thought that he would be aware of these things, and we still really don't understand why there was so little awareness of these issues, and why the government's response in 2008 was as incompetent as it was. When they finally did intervene, they intervened very massively, and they intervened to prop up the financial system, certainly necessary. There was little or no intervention on behalf of the real economy or the consumer. The Obama administration in many ways was a linear extrapolation of that, with one big exception. The big exception was a large stimulus. But if you look at the personnel in the Obama administration, in fact, it's not at all clear that the Bush administration might actually have had a more independent set of people. Geithner, who had been head of the New York Fed, now Treasury Secretary, Larry Summers became director of the NEC. Larry Summers had been deeply involved in most of the deregulatory legislative efforts of the Clinton administration, and had also been an extremely vocal opponent of the idea that there was anything wrong with the financial system in the 2000s. Most famously when in 2005, Raghu Rajan, who was then the chief economist of the International Monetary Fund, issued the first very public, very serious warning about the coming crisis at the Jackson Hole Conference. In the audience were Tim Geithner, Ben Bernanke, Alan Greenspan, many other people, and Summers was in the audience, and Summers rose up and argued very strongly that Rajan was wrong and called him a Luddite. And so, Summers became director of the NEC. I would say even more disturbingly, people who had been deeply part of the bubble, and some of whom quite possibly should be under legal investigation now, and in fact may be under legal investigation, are now at senior levels in the Bush administration. So those people include Jacob Lew, who's been nominated to head the Office of Management and Budget. He was the chief financial officer of Citigroup Alternative Investments, which lost about $4 billion after paying its executives extraordinarily well. David Lipton also came from Citigroup. Michael Froman was also in Citigroup Alternative Investments, and in fact was paid a $2 million bonus after he had been appointed to go into the National Security Council in the administration. The Treasury Chief of Staff, Mark Patterson, was a lobbyist for Goldman Sachs. Louis Sachs who's a senior advisor to the Treasury Department, had been the head of Tricadia, a hedge fund which had worked with several investment banks to design securities so that it could bet against them, an issue to which I'll return. And then Gary Gensler and Mary Shapiro, the two principal regulators of the CFTC and the SEC respectively, had both been deeply involved with the industry during the bubble period, and Gary Gensler had played a major role in banning the regulation of derivatives in the late 1990s. William C. Dudley, who's Geithner's replacement as the head of the Federal Reserve Bank of New York, is the former chief economist of Goldman Sachs. So it's a remarkable set of personnel to run the administration. And it has been extraordinarily favorable to the industry. Now, that's kind of a very superficial description of what happened. And the question is, why did these things happen? And the two things that people have pointed to most immediately are incentive structures and lack of regulation. Now, the incentive structures, there's one set of incentive structures at the institutional level, and these are kind of the obvious things. Once the securitization food chain was in place, lenders, for example, no longer had much of an incentive to be careful about the kind of loans that they made, because they were simply going to sell their loans to investment banks who in turn were going to sell them to investors. And so it was going to be somebody else's problem. Now, it didn't have to be that way. It would have, in principle, been quite easy to construct contracts such that there would be reverse pass-throughs if losses began to accumulate in the system, and bad loans would have to be taken back and so forth, you know. But, and in fact, there are some weak provisions of that kind in the new financial reform bill, the recent financial reform bill. But there were no such provisions, or effectively no such provisions, during the bubble period. So, and then moving to the investment banks, they sold these to investors, and once again, they didn't have to care at the institutional level whether those investments worked over a very long period of time. The rating agencies were paid by the institutions issuing the securities, and so their institutional incentives were also very clear in a similar way. They were paid on a transaction per security basis, not even any kind of annual, you know, subscription fee. So in a very direct way, their income was dependent on the ratings that they gave to the securities that were issued. And their profits went up enormously. Moody's profits quadrupled. And in fact, Moody's was, during this period, the most profitable company in the United States, at least the most profitable public company in the United States. And then finally, it turns out that it's perfectly legal to create and sell a security with the intent of betting on its failure. And the derivatives market allowed people to do that, and they did that in a very massive way. And so not only did the investment banks make money simply through the transaction fees of packaging and selling these securities, but beginning in 2005, the investment banks, particularly, most notably, Goldman Sachs, started using derivatives, particularly, although not exclusively, credit default swaps, to bet against either the individual securities that they were selling or indexes which had been created of these securities. And in the case of Goldman Sachs, it's not clear exactly how much money they made, but we believe that it's in excess of $25 billion. So by doing this. So quite considerable sums of money. And others did this as well. Deutsche Bank, Morgan Stanley did it to quite substantial extent. However, a single Morgan Stanley trader, and this is kind of this is interesting and gets to the next issue that I'm going to discuss, which is incentive structures at the individual level. A single Morgan Stanley trader made a contrary bet, which ended up costing Morgan Stanley as a firm $9 billion, and which wiped out most of the profits that it made through betting against the securities that it was selling. Now, but this is the interesting part, is the individual incentives inside these institutions. So it's kind of, in a certain intellectual way, it's kind of boring and obvious that it might be in the interest of a company at the company level to sell stuff that's defective if it can get away with it. But what we know, of course, is that in a number of cases, these companies ended up destroying themselves. And the key to that is the individual incentives inside them. And this is what Rajan pointed out in his 2005 warning. Rajan's paper said, and I urge you to read the paper, it's available on the web, and it's quite brilliant, very, very prescient. And what he essentially warns about is the potential systemic risk of an industry which is predicated upon individual incentives where it's very, very asymmetric, where people get very heavily rewarded in short-term cash for making decisions that could have very, very large, very negative, long-term, non-cash consequences. And those incentive structures came to dominate the operational portion of the industry. Now, I will distinguish between the operational portion of the industry and the strategic portion of the industry. When I say strategic, what I mean is essentially very senior executives and boards of directors. The operational portions of the industry came to be dominated by short-term cash bonuses, which were heavily short-term performance-based. So the transactions that you did that year brought in fees, and you got a certain fraction of the nominal value of those transactions in cash that year. If you were a senior executive, your compensation was more heavily weighted towards stock, typically, more heavily weighted towards stock, and was related to the profitability of the overall firm as opposed to the transactions in which you engaged or your business unit engaged. And you might usually think that that would have a beneficial effect on the time horizons of and decisions of these senior executives. But it turns out that it didn't. And it didn't for a couple of reasons. The first is that their vesting regimes were typically quite short. So they typically had 4 or 5 year vesting regimes, and they could sell, this is the key part, and they could sell their stock as soon as it was vested. And so what you see, and they also got very significant annual cash bonuses as well. It's not like all of their compensation was in stock. It certainly was not. People have examined the compensation and income behavior of the senior executives of Bear Stearns and Lehman Brothers. And in both cases, the top 5 executives of those two firms, of each of those firms, took out over $1 billion in cash in the 5 years prior to 2008. And so when their firms collapsed, yes, they did have some significant paper losses. Dick Fould's net worth declined from $1.2 billion to $400 million as a result of the collapse of his firm. But he still had over $400 million. And you know, when that's the kind of position that you're looking at, that, you know, I would tend to think that has an effect on how much you care about your firm. There were even more extreme cases. The most